Hey, everybody. Welcome back to another Five Plan Partners educational blog. Mark Hume here with you today, and we're going to discuss life insurance. Form of risk management helps you take care of your family. But what we want to focus on is why it should be real personalized to you, who you are, how you feel about this particular topic, and then applying the appropriate product and the appropriate price for the solution that you want to provide for you and your family. So most of my time here at Five Plan Partners is spent thinking about you and what is best for you, both today and in the long term. That's the very foundation of the fiduciary work that we do here. Take that very seriously. Really enjoy spending time personalizing a wide variety of recommendations from a planning perspective for clients. And risk management is one of those important topics that we always have to cover at some point during our conversation. The truth about you is that you're different than other people. You have different preferences. You have different goals. You may see something a little bit different than another client. You may have different philosophies to many of the different areas that we conduct planning in. And so it's really important for your advisor to know who you are and what you prefer in building any solution for you. The solution of life insurance is no different than any of those other topics. You have a certain set of circumstances. You're at a certain phase in life. Your kids are a certain age, and you're making a certain amount of money. And your spouse may or may not be generating money as well. That's important to consider also. There's a number of different factors that go into determining how much death benefit you need to provide for someone in the event that something unlikely happens to you. So what are we trying to solve for here? We want to pay off debt. We want to provide for college. We want to replace some income. And don't forget that if something happens to you, you've got Social Security survivor benefits, and that is paid to both your spouse and each of your surviving children. It's important to understand what that amount is and include it in the calculations for determining what the appropriate death benefit is for you. One of the things that I've run across a lot recently is a significant amount of overselling of different life insurance products and implementing products that just don't really make a lot of sense for the people that they're sold to. So that boils down to the incentive, right? Someone who works for a captive life insurance agency is heavily incentivized to sell that specific product or sell their suite of products, I should say. And within the context of those suite of products, there are certain policies that will pay them significantly more. And they are compensated on how much you spend on your insurance program. And so that throws any objectivity completely out the window. Another reason I wanted to discuss this topic today is because those salespeople who are trying to get you to spend as much money as possible on insurance, they are very good at keying on your emotions. And once your emotions have been triggered, it's really easy to make decisions that may not be really well thought through. So my goal when having risk management conversations, let's have real practical, real objective conversations and arrive at a conclusion that is the best for you both today and in the long term while removing the emotions from this conversation. I think that's really valuable for anyone when you're having any risk management conversations. For most people who are working and raising a family, some simple term insurance in 20 or a 30-year block makes a lot of sense. It's simple, it's easy to understand. The cost is minimized. We'll look for high quality companies that are offering the best rates, and we will implement the appropriate amount, like we discussed earlier, Social Security survival benefits. How much debt do you have? How many people do you have to provide for with college? How much income do you need to replace if you were not there? If you're reasonably healthy, it's pretty inexpensive. It's pretty easy. And one of the benefits of COVID is that accelerated underwriting really took a lot of steps forward. So if you're generally a pretty healthy person, a lot of times you can submit an application, complete a telephone interview, and potentially have a policy issued. Permanent insurance is one of those topics where I see a lot of overselling and a lot of inappropriate products in place. And permanent life insurance is not absolutely necessary for most people, but there is certain products that can provide double benefits if that's where you want to allocate some of your resources to mitigate risk. So what I'm talking about there is certain universal life insurance policies will provide you access to the death benefit if you have a long-term care event. We all know someone who's been through a long-term care event. We've all heard real challenging stories about how expensive long-term care events can be. And one of the only ways that I like permanent life insurance is if the insured has access to the death benefit, if they have a long-term care event like Alzheimer's, or if they have physical issues getting up and moving around and taking their medicine and eating and things like that. Couple of really important details to pay attention to when I'm designing these particular solutions. We want to make sure that if someone goes on a claim, they're not required to continue paying insurance premiums. Some companies will require that, some don't. So you got to dig down in the details just a little bit to make sure that you're providing the best solution for your clients. And that's something that we take real seriously here at Five Plan, and we pay close attention to those details. These long-term care riders, which give you access to the death benefit, the way that we'll design the products is that they'll cover most long-term care risks. And that's what we're trying to do, right? Because, I can find a story about someone who had a long-term care claim for 10, 12, 15 years, but the truth is that most people are on claim for about 3 years. PwC did a recent study a couple of years back that suggests that the median cost for long-term care was about $125,000 or $130,000. That's a few years back. So that's inflated a little bit since then, but it's not these $500,000 expenses that you will see cited. Those are the outliers. We can't cover every single risk logically when we're trying to implement these solutions. So we want to cover most risks, things that most people will be exposed to. And to wrap up the conversation on the permanent life insurance piece that I like a lot in certain situations, it provides a guaranteed return on investment. You can go buy a long-term care insurance policy that specifically covers a long-term care event. And in those situations, if you don't use it, you lose it. And those are really expensive policies these days. And so to me, it just doesn't make a lot of sense to throw a lot of money into something for 20, 30, 40 years with a 50-50 chance, because that's roughly about how much, that's roughly the likelihood that you will need a long-term care event. So I don't want to have a coin flip odds where I may get no return on the investment, especially when the premiums are significant. So in that permanent universal life insurance situation, there's a guaranteed return on investment because when you pass away, it will pay out the death benefit. And if you've used some of that death benefit for a long-term care event, you've just accelerated that return on investment. So I wanted to have this conversation today just because I've spent a lot of time helping folks make sense of these very complicated insurance packages that have been put together for them over the years. It's very confusing. It's really overwhelming. And we're slowly helping to unwind where it makes sense. But again, remember, when we're solving for these different risk management needs, it's a real personal decision. So it's not a cookie cutter solution. You think about who the person is, the things that they prefer in life, how do they want to address this risk, and then what are the resources to fund this risk. We don't make blanket recommendations that a permanent life insurance policy solves the long-term care event. We're not here to sell you as much insurance as possible. We're here to provide you with what makes the most sense for you. A lot of folks will use a self-insurance. That just means using the investment assets and the cash that you have to pay for long-term care. And that can make a lot of sense, especially if you have a lot of non-qualified investment accounts. If you have most of your wealth tied up in retirement accounts, then we'll talk about the tax impact if you're having a long-term care event of having to distribute more money from tax-deferred accounts that's generating ordinary income to get the cash out of the retirement account to pay the long-term care insurance bill. So you can see where the way that your assets have been accumulated over the years can have a big impact on the tax burden that you feel when you're paying for a long-term care event. There's a wide number of varieties that we cover, and it's important to be real thorough and understand someone's situation, both objectively with the assets that they have and how they prefer to manage the different type of risks that exist to them throughout their life. So I appreciate you stopping by to have a little conversation about risk management and life insurance. We've just had way too many folks been oversold that we've had the chance to meet with lately. So I thought I wanted to share my thoughts with you as I've been working through these different situations. If you want to have a specific conversation about that topic or any other topics in investment management and financial planning, don't hesitate to reach out to us here at Five Plan Partners, and we look forward to seeing you next time.